Imagine waking up tomorrow in a world with no money. No cash, no bank accounts, no UPI, no salary. You grow vegetables, but you need clothes. The tailor needs grains, but wants milk instead. And the milkman wants something else. This was not a thought experiment. This was human civilization thousands of years ago. So the question is, how did money come into existence? And why does a simple piece of paper or even a digital number have value today? To understand modern finance, we must travel back in time, to the very beginning. In the earliest societies, there was no money. People exchanged goods and services directly. This system was called barter. You give wheat, I give rice. A farmer trades with a potter. A hunter trades with a farmer. Simple, but only on paper. Barter had three major problems. First, double coincidence of wants. Both parties had to want exactly what the other offered at the same time. Second, no standard value. How many pots equal one goat? Who decides? And third, no storage of value. Food rots, animals die, wealth disappears. As societies grew larger, barter became inefficient and chaotic. Humanity needed something better. The solution came naturally. People started using items that were durable, scarce, divisible, widely accepted. These were called commodity money. Different civilizations used different things. Salt in Rome, cowrie shells in India and Africa, grain in Mesopotamia, livestock in early societies. Interestingly, the word salary comes from salarium, a payment made in salt. But soon one commodity stood above all others: metal. Around 600 BCE, in the kingdom of Lydia, modern-day Turkey, the first metal coins were minted. Coins were revolutionary. They had standard weight, guaranteed purity, and official authority. Gold, silver, and copper coins spread across Greece, Rome, India, and China. In ancient India, punch-marked coins were used as early as the 6th century BCE. For the first time in history, value became portable. Trade became scalable. Economies expanded rapidly. But coins had a limitation. They were heavy and dangerous to carry. The next breakthrough happened in China around the 7th century. Merchants began depositing heavy coins with trusted agents. In return, they received paper receipts. Soon, these receipts started circulating as money. This was the birth of paper currency. Paper money worked on trust. Trust that the paper could be exchanged for real value. When Marco Polo visited China, he was shocked to see people using paper instead of gold. Eventually, Europe adopted paper money, but not without resistance and failures. Why? Because once governments realized they could print money, temptation followed. Banks did not begin as modern buildings. They began in temples, palaces, merchant houses. Temples were considered sacred and safe, making them ideal places to store wealth. Over time, moneylenders noticed something important. Not everyone withdraws their money at the same time. So they started lending deposited money, charging interest. This was revolutionary. In medieval Italy, banking families like the Medici formalized lending, deposits, and credit systems. This laid the foundation for the modern-day banking. The word bank comes from banca, a bench used by money changers. This system created credit, investment, economic growth. Today, money has evolved again. Most money no longer exists as cash. It exists as bank entries, digital balances, electronic transfers. Modern money is called fiat money. It has value not because it is backed by gold, but because the government says it does. This system works on trust, regulation, and stability. And when trust breaks, financial crises occur. Money was not invented overnight. It evolved from barter to coins to paper to digital numbers. At its core, money is not gold or paper. Money is trust. Understanding its history helps us respect it. use it wisely, and avoid repeating past mistakes. This channel exists to explore finance not just as numbers, but as a story of human behavior. If you enjoyed this journey through time, subscribe for more insights into money, markets, and financial history. Because to master finance, we must first understand its past.